Let's talk about the markets now with Jack Caffrey, equity portfolio manager at JPM Asset Management. There's statistics, Jack, about, I don't know, 9 days in the last 10 years, if you were out of the market, that you missed like a lot of the gains. So people would like to stay long, obviously, but no one wants to stay for a 20% bear market, or even, be nice to get out before a correction and buy back in if it goes down 10 or 12 points. Did people miss their chance already this time?
I think there's an old adage that it's time in the market that matters more than timing the market. And it comes back to the idea of how difficult it is. When is euphoria too euphoric, and when is fear too dominant? And the sad characterization is those really great days that if you miss, you basically earn cash, tend to correspond to the day right after, everything felt like it was falling apart. And so that's where I think we come back to trying to emphasize diversified portfolios, built around different exposures, and trying to, at least in the strategies that I try to manage, that take lower expectations into the sorts of stocks that we want to buy, so that we can hopefully have a little bit more of a cushion when things get a little bit crazier.
I think I got my years right. The October sell-offs in 2022 and 2023, both times that happened, people said, no capitulation. We're going to need to test. I mean, strategist after strategist came in here saying, do not buy this market. And then remember, it melted up in 23 and 24. No one ever got able to wait for new lows to go back in. And the numbers, I think the numbers I'm talking about on the S&P are like, wasn't it they needed to test 3,200 or 3,300 or something? Wow. So remember that? That's where it was. Yeah. So why wouldn't you say right now that we definitely didn't see panic selling? We definitely didn't see capitulation. You didn't. Was it a ultimate bottom that we made a couple weeks ago?
The words ultimate and bottom should probably never belong in the same sentence.
Yeah.
Because, the ultimate bottom.
Or picking your bottoms is gross.
Call it March of 2009 when we got a 6.
Do not pick your bottom. Yeah.
On the S&P 500, that was long ago and far away now. I tend to look at a variety of indicators that suggest whether there's more panic or more greed. Implied volatility got to the high 20s. That doesn't really feel like people are completely terrified in terms of their exposure. Yes, volumes exploded, but we've also seen volumes explode with more quantitative trading.
It was weird to hear people talking about capitulation, because it did not feel like a market that was panicked enough to have.
It was certainly not panic selling. And if you look to the credit markets, credit spreads were not widening.
Right.
They're a touch wider, but primarily because 10-year yields went down, not because people were selling credit. So as an equity investor, I look at credit, and credit's saying we're confident we're going to get our coupons. That makes me suggest that people are going to generate the earnings we're looking for. Will we get the upside surprises? Maybe not over the next quarter or two, but the beauty of accrual accounting is you can find that incremental penny. And ultimately, at some point, you do have to turn that into cash. So I don't think you had panic that was going on. You did see some retail surveys of sentiment indicate that they were cautious in the short term, which isn't necessarily something you would think unlikely, given how much the gains were over the prior 2 years.
Should we have seen this coming a little bit? I'm not talking about fundamentals with tariffs and everything else, but I mean, the Mag 7 were controlling everything in terms of where the levels were. That was where all the money was headed, and then that stopped.
Well, the Mag 7 really led us in the first half of 2024.
And then that petered out, and we were hoping
went sideways.
We were hoping for broadening. We didn't get broadening. We got a correction.
You saw broadening. You actually wound up seeing over the back half. You saw people looking for what's the second derivative trade off of the build out of AI. So we started talking about utilities. Oh, we're going to have growth in electricity demand for the first time in decades. You started seeing natural gas doing much better, despite having been typically almost a byproduct where you were giving it away at points in time in parts of the West Texas energy markets. So suddenly you might say, when we're looking for second and third derivative trades, maybe the main trade is sort of played out, well understood, and potentially well owned, and you start seeing some mean reversion in terms of what investors want to pay. So trying to call when investors decide I've made enough, that's a tricky one. And I will admit I don't have great skill in calling that particular data point. It's easier to say people are terrified than when they're perhaps complacent or they're feeling satiated in their greed.
So you think we end the year higher than where we are right now? And if so, what leads the market this time? Same stuff?
I think market certainly has to get led by earnings rather than valuation. And we've lived through some pretty dramatic.
Well, then the Mag 7, that's where the earnings growth
That's
still
certainly
is.
where earnings is, and some of the Mag 7, you start looking at market multiples rather than looking at premiums to the broad market. And some of them have posted earnings such that they've actually almost gotten, can't say cheap, but they become much more reasonable against the growth that's expected within them. Given all we were talking about growth for the last several years, who would have thought energy would have been in the lead on this year? And energy's leading with oil prices down. So it certainly seems like traders are willing to try to find some parts of the market that have been perhaps ignored or set aside. They might be looking for businesses that benefit from a weaker dollar rather than a stronger dollar. Oil dollar denominated, so a weaker dollar actually makes oil cheaper to many of those oil consuming economies. You've got stimulus in Europe for the first time that's, rather than purely monetary, it's actually turning into fiscal and on a scale, excuse me, that is larger than what the U.S. was doing during COVID.